What's going on, everyone? In this video, we are going to cover 5 mistakes to avoid as a new investor, because for new investors, getting in the stock market's scary. It feels like there's unlimited investments to choose from, and not to mention the fact that not all investments make money. But investing is one of the most important things you can do with your money, and I'm a believer that the best way to learn about things is to get your feet wet, try it out, make mistakes, and learn along the way. But when it comes to your money, making mistakes probably isn't something you want to do repeatedly, because simple mistakes can cost you thousands of dollars over the long term. So by avoiding a few of the mistakes we're about to talk about, you'll be well on your way to becoming a successful, confident investor. So the first mistake is killing compound interest. One of the biggest mistakes I see from new investors is stopping compound interest and not letting it do its thing. And compound interest is where your returns earn returns on your previous returns.
Earn. Let me see. Earn. What?
So an easy example is that if you had $10 invested and you earned a 50% return, you would have a $5 return and your total amount would then be $15. Then if the next year you earned another 15% return, that return would actually be $7.50 because you were starting with $15 instead of $10. But when you sell investments, you're stopping their growth, and if you're investing for the long term, you want to experience as much of that growth as possible. And this is why I believe it's important to have an emergency fund before you start making investments, because an emergency fund is just a separate savings account where you have 3 to 6 months of expenses saved in case any emergencies or unexpected expenses come up. And if you didn't have an emergency fund established before you started investing, if an unexpected expense came up, you'd have to sell off your investments, you may have to pay taxes or penalties, and then you're basically back at square one. So if you're just getting started investing, build up a small little emergency fund with 3 to 6 months of expenses saved up. So in the case of an emergency or unexpected expense, you don't have to sell off your investments, and you can continue to stay invested and experience the growth of the stock market. And the second mistake to avoid is following random advice on social media. And I was going to label this one as following the trends, but recently, following the trends really hasn't been the worst investing strategy. We've seen a slight shift away from traditional investment philosophies to the now popular meme investing. But regardless if you're a meme investor or not, following random advice on social media is something that's happening way too often nowadays, and it's one of the most detrimental investing mistakes that you can make. So if you see investing advice online, or some random person's telling you that you need to make this investment or buy this stock or buy this NFT, always do your own research and evaluate the investment to make sure if it makes sense for you and your situation. And the third mistake is investing in things you don't understand. And similar to the last point, you should always understand what you're putting your money into prior to doing so. And with how popular crypto and NFTs have become in the past year, I've seen countless people throw their money into investments that they don't really understand, and I know this because they've told me they didn't understand it. They had seen something on TikTok or Twitter about an investment, just blindly followed it and bought the investment. And this could play out okay, or they could end up losing a lot of money. You just never really know until it actually happens. But if you understand something before you invest in it, then you have a reason behind it, and you have your purpose behind making that investment. And if it doesn't play out how you thought it would, it's okay. Not every investment's going to make money. But the point is that you would have done research and understood what the investment was and made a logical choice rather than putting money on the line based off something random you heard from someone. And the fourth mistake is comparing returns to others. In the age of social media, comparing ourselves to others is a harmful aspect, and when it comes to your investments, it's easy to get discouraged when you see people posting about their 100x returns on TikTok or Twitter when they're investing in crypto and NFTs and things like that. But it's important to know that those investments are not for everyone, and getting stupid high returns is definitely not normal. And with this, one crucial piece of the investment equation that people who boast 100% returns fail to mention is the amount of risk that they took on to do so. Trying to beat the market and get crazy high returns comes with a very considerable amount of risk, and you personally may not be willing to take on that much risk. And when you compare your investments to others, you may not be making a truly accurate comparison, because if your investments returned 20% but they were fairly low risk, you're probably going to be happier and sleep better at night than someone who got 150% returns, but there was a 50-50 chance that they were going to lose everything. investing. And one way this mistake can partially be avoided is by defining your goals, which leads us into our last mistake of not defining your goals. So prior to making investment, it's crucial that you define your goals, because your goals are going to dictate how you manage your investments and how you're going to build your investment strategy. For example, let's say that you wanted to invest because you wanted to save retirement. And if you're 25 years old right now and wanted to retire at the age of 50, that means you have 25 years to invest in the stock market. Knowing this goal then lets you work backwards to determine how much you need to be saving month to month and year to year to then hit that end retirement goal. And let's say the end retirement goal is $2 million. If you're making consistent investments and you're on track to hit that $2 million with 10% returns, it shouldn't really matter if someone else is earning 100% returns, because they might be chasing different goals and they're playing a different game. Also, defining your goals is going to help determine how and where you're going to invest your money. For example, if you wanted to invest because you wanted the money saved for a down payment on a home to grow, but you only had a 5-year time frame, you might not want to invest that money in higher risk things, because there's a chance the market could go down, and then the amount you would have saved for the down payment on the home would go down as well. So if you have a short time frame, it might make sense to not invest and just keep that money in savings so it can kind of grow a little bit and you don't run the risk of losing that money. But overall, defining your goals for the investments you make is a necessity. No matter the goal, it needs to be established so you can then know the purpose of the investment and take the appropriate actions. A classic saying in the financial world is that investing should be boring, and I generally agree with this. Most people don't want to think about their investments all the time and just want their money to grow over time. And with a more passive approach, you can invest in things like ETFs or mutual funds or target date funds and take a more set it and forget it approach and put your money on autopilot and be just fine. Now, there are many different approaches to investing, and there's definitely no right way to do it, but as long as you always put your own situation first, keep some of these mistakes in mind, you're going to be well on your way to becoming a successful, confident investor. But that's all I got for this video. I hope you enjoyed it, and we'll catch you in the next one. Later.